Hello everybody, thanks for attending our webinar today on inheritance tax planning and maximising available reliefs. Just a bit of housekeeping before we get started. For the best audio and visual experience, it's important that you quit all other applications that you might have open, any websites, Skype, email, etc. It should help with this broadcast today. If you have any questions during our webinar, there is a box there that you can type the question into and then click send. What we'll probably do is we will answer the questions at the end of the seminar because we only have an hour and quite a lot to get through. So we'll plough through it, and at the end we'll answer as many questions as we can. Okay. If you want to get rid of your control panel or minimize it on your screen, there is a little box there, as you can see in the slide, little arrow that you can just click, and that should reduce that for you. Okay. Just before we get started and get into the tax side of things, just a little bit on RDA ourselves. RDA Accountants was founded by Paul Redmond and Jim Doyle. That's the R and the D. We merged recently with RJ Smith in a Carlo practice. I suppose the bottom line there is the management team. That's myself in the bottom left-hand corner. My colleague Michael will also be giving a bit of this presentation today. Marie heads up our marketing department. Kevin O'Donnell heads up our accounts department in the Wexford office, and Michelle Keogh heads up the Kilkenny office. Okay. Small bit about myself. I suppose most importantly with regards to this presentation, I'm a qualified tax consultant and a member of the Irish Tax Institute, and I have a number of years now working in that sector. Michael then has 10 years experience working as a qualified financial advisor. He's a fellow of the Life Assurance Association of Ireland. He's a licentiate of the Compliance Officers of Ireland, and he's a retirement planning advisor, so he's well qualified to advise on certain aspects of this presentation today. Okay. So essentially today's presentation is about succession planning and how we might set about doing successful succession planning. When we sit down with any of our clients to consider what the next step should be, we look at these points and we work from there. So the first is the wishes and planned exit date of the current owners, the ability of the current owners to fund their retirement, the management and ownership capabilities of possible beneficiaries, and I suppose where I step in then is taxation, and I suppose that's the core of our presentation today. But I guess the key point and what we'd look to do is we sit down with our clients, we try and ascertain what they want to achieve, and then we look to do that in the most tax efficient way possible. Okay. So with that in mind, and with the tax side of things to be covered, we're going to look at capital gains tax and capital acquisitions tax. Okay, so namely retirement relief and a company purchasing its own shares from a capital gains tax point of view. I'll then look at business property relief and agricultural relief before Michael takes over and examines Section 72 life cover and CAT on the transfer of pension funds, or AFS. Okay. So to get started, when transferring assets within a family, including business assets, capital gains tax is a tax that will have to be considered. I'm sure you're all well aware how capital gains tax works. It's essentially a tax on any gain made on the transfer of chargeable assets, and chargeable assets will include goodwill or any other assets used in a family business. Okay. With that in mind, we must consider retirement relief. Retirement relief is essentially the most important capital gains tax relief when transferring assets within a succession planning scenario. Okay, so retirement relief is set out in Section 598 and Section 599 of the Tax Consolidation Act. Section 598 relates to transfers between third parties, and it sets a lifetime limit of 750,000 with regards to which retirement relief can be claimed on this threshold. That threshold is reduced to 500,000 if the individual qualifying for retirement relief on the transfer is over 66 at that date. Section 599 then deals with transfers within a family, so basically from an individual to his son or daughter. In that scenario, there is no lifetime limit unless you're above 66 again, and at that stage a €3 million limit applies. With regards to retirement relief itself, you have to be over 55 before you can qualify. It'll only qualify on the sale, or it'll only apply to the sale of qualifying assets. And the name itself is actually a bit of a misnomer. There's no requirement at all to retire. Okay. So I'm going to try my best not to make this presentation too technical and to use examples where we can, but in certain instances I'll quote some legislation. That's the case here when we look at qualifying assets. Okay, so qualifying assets include chargeable business assets, which are essentially assets of the business. So if we think about a sole trader business, goodwill, property used in the business, which were owned for at least 10 years and which were chargeable business assets for that 10-year period. Okay, so I'm going to look at an example in a minute to illustrate that. Qualifying assets would also include shares in a family company owned by the individual for at least 10 years, in which the individual has been a working director for at least 10 years, and importantly, a full-time working director for at least 5 of those years. And it also includes assets owned by the individual and used for his or her family company. Okay, so we're going to look at an example now to illustrate a qualifying asset. Okay, so in this example, Marcus carries on a trade of manufacturing ice cream. He also owned a lock-up garage for over 20 years, and for most of that period had rented it out to various tenants. In 2006, Marcus resumed occupation of the lock-up garage as he needed it to store raw material for the expanding ice cream business. In 2012, Marcus sold the ice cream business, including the lock-up garage. So the temptation here might be to assume that because Marcus owned the business and the property for more than 10 years, that it will qualify now for retirement relief. But the fact of the matter is that in this case, the asset itself, the lock-up garage, has only been used in the business for 6 years and therefore would not qualify for retirement relief. Okay? So then that's just looking at it from a sole trader point of view and an asset used by a sole trader. Now we must consider shares in a family company and what might qualify for retirement relief. So a family company in relation to an individual means a company in which the voting rights are not less than 25% exercised by the individual, or not less than 75% exercisable by the individual or a member of his or her family, where not less than 10% exercisable by the individual himself or herself. So the key point here is to beware of part disposals, as this may lead to the test being failed. And again, we're going to use a kind of quick example to illustrate that point. So here, Fred inherited 50% of the shares in a trading company at the 30th of June 1991. On the death of his father, the balance of 50% of the shares is held by an unconnected person. On the 28th of August 2004, Fred disposed of 30% of his shares in the company to a new investor. So in this scenario, as his shares before disposal amounted to 25% or more of the voting rights and had been held for 10 years, they were shares in the family company for the purpose of retirement relief. The key point here is now Fred retains 20%. So in April 2005, when he disposes of that 20%, the shares no longer qualify as a family company, and retirement relief is not available on that second transfer. So with a little bit of foresight, a little bit of planning, it might have been possible for Fred to structure those sales in such a way that retirement relief would have applied to both sales, if you like. Okay. There is a potential pitfall when dealing with family companies, and that essentially retirement relief is there to apply to the transfer of business assets. Now, family companies do not necessarily only own business assets, especially during the boom years. Family companies were used to make investments because cash might have been in the company, it might have been available and might have been used to purchase property or shares or any other investment asset. So you can have a scenario now where the actual value of the company shares is made up of the value of the business itself plus the value of investment assets held by the company. Now, if that's the case, the retirement relief available will be diluted. You have to actually apportion the proceeds between the chargeable business assets, being goodwill or any property used in the business, as opposed to total chargeable assets, which would include the goodwill, the property used in the business, but also any other investment assets held by the company. This is something we've come across recently with a client of ours who had a pub business, but the actual shares in the company were pretty much all related to investment property that had been built up in that company over the years. So what we had to look to do, because the transfer of shares to the son would have been so heavily diluted, what we had to look to do was to set up a new company and hive that pub business out into that new company, claim the different reconstruction reliefs that are available there, and we'll now be able to claim retirement relief on the transfer of those shares to our clients' children. Okay, so it is possible, it can be fixed. It's just important that it's recognised before retirement relief is incorrectly claimed. Okay. So your sole trader business is straightforward. If it meets the conditions, held for 10 years, the chargeable business asset, it'll qualify. We've been through shares in a family company. But what about assets held outside a company that are used by the family company? So this is again a relatively common scenario where director, a majority shareholder, actually owns the property from which the company operates. So in that case, again, retirement relief can be available provided they are sold at the same time as the business. Okay. I suppose what this gives is a degree of flexibility in that we mentioned a threshold of 750,000. If, for example, the business was worth 600,000 and the property was worth 400,000, so to combine that would be €1,000,000, and retirement relief wouldn't be available on any sale to a third party. It might be possible then to delay the transfer of the property, so at least retirement relief might apply to the sale of the business being the 600,000, and then CGT as normal might apply to the 400,000 sale of the property. Okay, so it does allow for a degree of flexibility, particularly when selling to a third party. Now, to counter that, there are situations when transferring within a family where I've seen the mistake being made of the business transferring before the property. So just to use an example here, Thomas, 57, transferred his shares in XY Limited to his son Tommy on the 1st of December 2012. Thomas retained ownership personally of the building from which XY Limited operate from. He then transferred this building to Tommy on the 1st of December 2014. No retirement relief available in relation to transfer, lack of forward planning leading to unnecessary tax liability. Okay, so I mean, in some cases, the parents won't want to transfer the property. It gives them security into their retirement, and that's fine. Like, if there's commercial reasoning behind it. But here we have a situation where the property was to be transferred within 2 years of the original transfer. It should have been possible to structure it in such a way that the property transferred with the shares. I've seen this mistake made. I've had clients come to me who now wish to transfer the property and didn't realise that because the business transferred previously, there was no relief available. So again, the most important thing is that any claim for retirement relief or any transfer of assets in a family is carefully planned. Okay. Given the audience that this is aimed at, being yourselves in the legal profession, we have a note here on how the partnership might be dealt with from retirement relief purposes, and namely the property used by a partnership. So essentially put, if a partner owns the property for which the partnership operates and transfers that property at the same time as he's sharing the partnership, retirement relief will be available in line with any market rent that was charged by that individual to the partnership. Okay, so if he or she charged market rent, well then retirement relief will be in line with their share in the partnership. If no rent was charged at all, then full retirement relief may be available. So again, just a quick example to illustrate this point. Mr. A is a solicitor in partnership with Mr. B and Miss C. Mr. A leases the office building he owns personally to the partnership at market rent. Should all other conditions apply, retirement relief will only be available on a third of any future gain made on the sale of the office building at the same time as he's sharing business. This because there's 3 partners. His partnership, he owns a third of the partnership, and retirement relief is available in line with this. Okay. So just before we move on from retirement relief, a key point, some recap. The most important thing is that it's planned. Okay, it's a incredibly important relief, but sometimes I come across people who work on the assumption that because I'm 55, because I've been in business, I can claim retirement relief. That may be true, but it's important that, especially if dealing with a family company, that there's no dilution of the relief. That if you're transferring the property with the family company, is the relief, will the relief be available? What about aggregation? Has there been any previous transfers? And with that in mind, it's important to note that transfers between spouses, while there's no CGT liability, can impact on the threshold for aggregation purposes. So again, it's important that the thing is planned out and that a clear plan is put in place, and that retirement relief is correctly claimed, because without it really, the transfer of family assets would just cease. Okay. So that's retirement relief. The next thing we're going to look at, I suppose, won't apply to yourselves personally unless you have other limited companies, but it might be an important tool for your clients. Essentially what this is, a cash extraction tool. If you have a client who has a family company, has built up cash in that company and now wishes to transfer shares to the next generation, this approach may allow that person to extract that cash from the company tax efficiently while at the same time transferring the shares. Okay, so a share buyback then, to get started and to break it down, I suppose, in the normal course of business, a share buyback will be liable to income tax, okay, and PRSI and USC. However, when certain conditions are met, capital gains tax will apply. If the capital gains tax treatment is secured, then retirement relief is available. Okay, so you may have a situation where you can extract cash from the company by the company buying back shareholder shares, almost potentially tax-free if retirement relief is used. Okay, so the key point here is, how do we secure capital gains tax treatment? And I suppose each of the conditions listed on this slide now have to be met for this to apply. So the shares bought back must be in an unquoted trading company. So this will be fairly clear. It will be a matter of fact, and that query is easily answered. The vendor's interest in the company must be substantially reduced as a result of the share buyback. So what that means is, by substantially reduced, is that at least 25% reduced, okay? And the important point here is that when shares are bought back in a company, they're cancelled from the register. So if there was 100 shares before the share buyback and 25 are bought back, there will be 75 left. Okay. Now the key point is that 25% reduction must be related to the shares left after the buyback, not to the shares beforehand. So 25% reduction is not as simple as buying back 25 shares of 100. Okay. Just that's a key point. The shares bought back must have been held for a continuous period of 5 years ending on the date of the buyback. Again, this will be known. Immediately following the buyback, the vendor cannot be connected to the company. So a person will be connected to the company if they can control 30% of the share capital. Okay. The acquisition of the shares by the company was not formed part of a scheme or arrangement, and it must be carried out for the purposes of benefiting the trade. This is, I suppose, where the grey area exists. Benefiting the trade. What does benefit the trade? And this is a test that must be met for capital gains tax treatment to apply. So when we talk about the trade benefit test, the test requires that it be shown that the sole or main purpose of the buyback is to benefit a trade carried on by the company. The test would not be met where, for example, the sole or main purpose of the buyback is to benefit the shareholder. Now, to my mind, there's no reason why any potential buyback can't benefit both, okay? And what we have here are some examples of scenarios that would potentially meet the trade benefit test. I suppose the most common one you would use in a succession planning scenario is the second one: a controlling shareholder who is retiring as a director and wishes to make way for new management. Okay. When it comes to the trade benefit test and a share buyback, I think it's very prudent that advance opinion be sought from revenue. Simply because if the company's buying back shares valued at 700,000 and retirement relief applies, well then the tax liability could be nil. Okay. If income tax treatment applies, well then you could be talking a 52% tax bill essentially. So that's half of the 700,000. So the difference could be 350,000 euro of a tax bill versus no tax bill at all. So you need to be confident that you're meeting the conditions to secure capital gains tax treatment. So if there's any uncertainty at all, it's certainly prudent to request advance opinion from revenue. Okay. And at the moment, revenue have a prescribed a method for doing this. You've probably seen it where they have a kind of spreadsheet that you just fill in each section of that sheet, outlining your area of uncertainty, and they'll respond then usually within about 4 or 5 weeks. Okay. So that kind of concludes capital gains tax and retirement relief and the potential for using a share buyback. What we want to look at now is capital acquisitions tax. Again, you're all probably well aware of how CAT works. Essentially, it's a gift or inheritance tax. And the tax only applies once the threshold has been breached. So the table on your screen now would show that the group threshold for son and daughter is currently 225,000. One of the reasons I put this table up is just to show how much that has dropped in the last 5 or 6 years. And if you remember, it was even higher. It was 550 something thousand at one stage. Okay. So the key point that will run through this is just protect the threshold, 225,000. Especially if you're transferring property, it can be exceeded very quickly, and once it's exceeded, there's no getting it back, and CAT at 33% will apply then. So one of the methods that might be used to protect that threshold is, of course, business property relief. Now, essentially, business property relief is a sister relief to retirement relief, especially when you're transferring assets within a family. You kind of don't get one without the other. The parent potentially transferring the asset will look to claim retirement relief from capital gains tax, while the son or daughter receiving the asset will have to consider whether they would qualify for business property relief on those business assets. Okay. How the relief works? Pretty straightforward. A 90% reduction in the taxable value of the business assets transferring. So we're going to use a very simple example to show this. So Michael inherited the family business on the death of his father on the 1st of May 2014. The taxable value of the business was 4 million. Business relief then is calculated as follows. So assuming all the conditions are met, there's 90% reduction. So rather than being taxed on 4 million, the individual is taxed on 400,000. Now, while this is above the threshold and a CAT liability will arise, it's considerably less than what that CAT liability would have been on 4 million. Okay. So the relief applies to business property. So that's on quoted shares or securities of a company. Property consisting of a business or an interest in a business. So that's your sole trader business, your partnership. Land, buildings, machinery or plant owned and used by the owner or a company controlled by the owner. So in a partnership or sole trader scenario, that's pretty straightforward. And for a company, we'll look at it in a bit more detail later, but it's essentially the same scenario where the property used by the company is owned by the shareholder. And finally, quoted shares or securities of a company which are owned by the owner prior to becoming quoted. So this is very rare. You might never come across a situation like that. Okay. So I guess the most complicated part of that is unquoted shares. So unquoted shares will qualify for the relief provided that the company is incorporated, which again will be a matter of fact, and any of the following three tests are met. That's the key point. It's any of, it's not all three. So the beneficiary needs only satisfy one of the following, or more than 25% of the voting rights. Okay. Control the company within the meaning of Section 27. Okay, so to control a company within the meaning of Section 27, the beneficiary, together with certain other persons, essentially their relatives, must control the company and own more than 50%, or own at least 10% or more of the aggregate nominal value of all the issued shares and securities of the company, and have worked full-time in the company or group throughout the 5-year period ending on the day of the benefit. So these are the three main tests, and I'm going to illustrate each of them now with a simple example. Okay, so with regards to the first test, the shares in a private company are held as follows: Mary 30%, David 35%, and Tony 35%. These shares have the voting rights. Mary gives her shareholding to her son Peter. As Peter will have more than 25% of the voting rights, he will therefore qualify for business relief. Okay, so very straightforward. Use the same example, but in this case, Tony and David are Mary's brothers, and Mary gives her shareholding to her son Peter and their daughter Jane. So in this example, Peter and Jane are getting 15% each, so they won't meet the first test. However, they will have control of the company within the meaning of Section 27, because together with their relatives, they will own more than 50% of the voting rights. Okay. The last example then is probably used in a situation where a family might want to give shares to an employee who had maybe worked with the family for years. Okay. In this example, a private company shareholding is held as follows: Mary 30%, John 60%, and Michael 10%. Joe Brennan, unrelated, has worked in the business full-time since January 2000. John gives a 10% shareholding to Joe. Shares qualify as relevant business property and therefore qualify for retirement relief, because John will have 10% and he worked in the company for more than 5 years and on the day of the gift. Okay? Okay. So then that shares in the family company. And what about land or buildings used for the purpose of the business? Again, almost identical in terms of retirement relief is that the land or buildings are going to have to transfer at the same time as the business for business relief to be available. So in order for land and buildings, plant, machinery to qualify for business relief, they must be given at the same time as an interest in the business or partnership or shares in the company. The point of the legislation is to give relief on the passing of business and not just assets which can be used for a business. Again, if it's not planned properly, you're hit with a double whammy of retirement relief not qualifying on one side and business property relief not qualifying on the other. And while there may be same event relief for CAT purposes if capital gains tax arises, with a bit of careful planning, it's something that can be not necessarily arise. Okay. So again, quick example. John is a partner in an accountancy practice and personally owns the premises out of which the practice operates. John gifts his interest in the practice along with the premises to his son, Paul. As the interest in the partnership qualifies as relevant business property and as the premises is transferred at the same time, Paul will qualify for business relief on both transfers, assuming the other conditions are met. Okay? There are some exclusions for relevant business property, and these are important to note, and again can lead to a dilution, particularly within a family company scenario, because in your own business, for instance, in a partnership scenario, you can separate the assets which you gift. So if you hold business assets and investment assets, you gift the business assets and potentially retain the investment assets. When you're gifting shares in a family company, again, the value of those shares may not necessarily be made up solely of business assets, and that can lead to a dilution of the relief. And again, we're going to use a quick example just to show this. So a businessman, on retiring in May 2013, gives his shares in the family company equally to each of his 2 children. It is determined that the value of the shares received by each child was 800,000 at the date of the gift, and that 700,000 of that value was attributable to relevant business property. So it's only 700,000 of that 800,000 which will qualify for business relief. So if you look at the example, the value of the shares was 800,000. We can deduct business relief being 90% of the 700,000 which qualifies, leaving a taxable value of 170. Now, a key point here, unlike retirement relief notes apportionment, and the apportionment happens whether 90% of the value comes from business assets or 90% of the value comes from investment assets. I think on reading the legislation related to business relief, if the majority of the company's value comes from investment assets, then it's likely that no business relief is available at all. Okay, so in this scenario, 12.5% of the company's assets value is coming from investment assets. But in a scenario where 70 or 80% of the shares value comes from investment assets, it may be the case that there's no business relief available. So again, it's important that it's planned. It's one of the reasons, again, when I talk about my client who had the pub business, why we had to hive out the business into a new company, okay, because business relief just wouldn't have been available. Okay, so key planning tip and something to be aware of when advising your clients or considering your own personal circumstance. Okay, when it comes to business relief, for business relief to apply, the property must have been owned for at least 5 years prior to the transfer in the case of a gift, or at least 2 years where the transfer gives rise to inheritance. Okay, and finally then a clawback, and there's a key point here I want to get across. There's a clawback of this relief if the assets cease to qualify as relevant business property or are sold. So if an asset is sold, that is straightforward. But the word I want to, within 6 years, the word I want to focus on is the word cease in point 1 here on the slide. So the key point here is cease. So if you or your client receives the gift of an asset, a business asset, and claims business relief, if within 6 years that business asset is put to any other use, for example, if it's let, there'll be a clawback of the relief. So for an example, not so long ago, we had a client who came in here and they had previously claimed business relief on the transfer of shares in family company and the property from which that company operated. The son now at this stage wanted to expand the business. He wanted to move to a larger facility and he wanted to lease the facility that he'd received from his father. He had received that facility about 4.5 years prior to this. So he was within the 6-year catchment area. So if he had let that property, there will be a clawback of the business relief that he received on the gift of that property from his father. Now, as it happened, we advised him of this and he still took the decision to let the property and just pay the clawback because he was happy that he wanted to push his company forward and he was happy with the lease he'd agreed with a third party. But at least he went into that situation fully aware of the potential clawback. So I suppose in your situation, when it comes to leases and drawing up leases, you're going to be advising clients. You're also probably going to be the person who transferred the property in the first place. So it's important that you're aware of that word cease to qualify. And if a client who's transferred property to their son within the last 6 years and the son now comes to you to draw up a lease, I suppose you better just point this fact out to him so that he has his eyes open when making any decision. Okay? So that's business relief, and that relates to business property. What we have then as well is another relief that you're all probably aware of called agricultural relief, which relates to the transfer of agricultural property. Okay, again, it works in the same way as business relief in that there's a 90% deduction. So again, quick example. In this example, John transfers agricultural property with a market value of 300,000 to his daughter Patricia. Patricia qualifies as a farmer. So we'll discuss the farmer test in a moment. Because she qualifies as a farmer, the value of the farmland is reduced by 90% and agricultural value is 30,000, and that's what CAT will apply to. So if the threshold is available, there will be no CAT on that transfer. Okay. So what is agricultural property? Well, as you'll see from the slide there, it's everything you might expect agricultural property to be. Okay. Pretty straightforward. It's anything agricultural land, livestock, farm buildings. Okay. So the key condition that must be met for agricultural property is known as the farmer test. And there's been some amendments to this in the last budget, which we'll look at shortly. But the key test is that to meet the farmer test, an individual must have assets, farm assets, which make up at least 80% of their total assets. Okay, so again, we'll illustrate this by an example. So the 80% test is clear. If farm assets make up more than 80% of your total assets, then you meet the farmer test. So in this example, Mary owns a house, not a farmhouse, valued at €80,000 with a mortgage of €20,000. So for the purpose of this calculation, it's only the equity in the house that's included, okay? So it's 60,000, being 80 less the 20,000 mortgage, okay? A car worth 5,000 and has 2,000 in the bank deposit account. So she has 67,000 of non-farm assets. She receives a gift of farmland worth 300,000 plus livestock and farm machinery worth 50,000. So is Mary a farmer? Well, she is, because of her total assets of 417,000, 350,000 of these are farm assets. That equates to 83.9%, and therefore the test is met. Okay. Again, there's a clawback of the relief if the agricultural property is disposed of within 6 years commencing on the date of the gift or inheritance and not replaced by other agricultural property, or if any of the conditions that are changed in the budget cease. So this is what we need to look at now in a little bit more detail. So up until the 1st of January this year, up until the recent changes in the budget, if you met the farmer test, happy days. On you claimed your relief, and as long as you held the property for 6 years, there'd be no clawback, okay? That changed from the 1st of January, and that from now on the beneficiary must farm the agricultural property for a period of not less than 6 years commencing on the valuation date, or lease the agricultural property for a period of not less than 6 years commencing on the valuation date. The agricultural property may be leased to a number of lessees as long as each lease and lessee satisfies the conditions of the relief. Okay, so you must meet the farmer test, and then either of those scenarios must be the case. Okay. In addition, the beneficiary or the lessee, and this is a key point, so if you lease the land, the lessee must meet these conditions, must have an agricultural qualification, or farm the agricultural property for not less than 50% of his or her normal working time. So that's a pretty onerous condition, particularly when we talk about a lease scenario. It seems to me the legislation would say that the person leasing the land is responsible for the lessee meeting these conditions. Now, in your profession, maybe that is something that can be prescribed in the contract, but it seems, I don't know how the revenue will police that. It's very onerous. It doesn't seem practical, but it is the case. So maybe it's something that should be noted in any contracts that are put in place, or any lease contracts that you do for your clients. Okay. Finally, the agricultural property must also be farmed on a commercial basis with a view to the realization of profits. So I think what that means is not that there will be profits in the business every year, because that's not the case of any business. But certainly revenue would not like a situation where there's losses every year. I mean, for income tax purposes, losses are not available after the 3rd year. They don't want a hobby situation, okay? They don't want to be a hobby farm making losses every year. So the farm will have to be farmed on a commercial basis with a view to realization of profit. So again, maybe another note that needs to be included in any lease contracts, okay? Just before we move away from agricultural relief, just a tip that might be available for yourselves or any clients who might currently have farmed and also have large amounts of cash. It's something that we've advised a number of our clients on over the last couple of years. There is an exception to the rule that the benefit must consist of agricultural property both at the date of benefit or at the valuation date. Where a benefit is taken subject to a condition that is invested in agricultural property, it will qualify for agricultural relief if the benefit is so invested within 2 years of the date of gift and inheritance. So the key point here is subject to a condition. So if you have a client that has a large amount of cash potentially on a farm, it might make sense from an inheritance planning point of view, particularly if that client or that client's son or daughter would like to grow the farm, that the cash be willed under the condition that it be invested in agricultural property. It's not enough. If I receive an inheritance of €1 million and I spend that €1 million on farmland, that will not qualify for here. I would have to receive that inheritance under the condition that I invest in farmland. Okay, so that's just a key point here. And finally, I suppose If agricultural relief is not available to any of your clients or yourselves, then it may be possible to apply business relief if the conditions for that relief are met. Okay. Just before I finish up then, I just want to again reiterate how important it is to protect those thresholds. It's because of those thresholds that we look at agricultural relief, that we consider business relief, because like I said, once those thresholds are gone, they're gone. So it's important to plan a will to ensure these limits are maximised while still allowing assets to transfer to desired recipients. So this might include maxing thresholds of grandchildren, of son or daughters-in-law, whatever might be done to ensure that thresholds are absolutely maximised. It also might include a trust structure or whatever else. I'll sign off, I suppose, by saying that you need to consider business relief, you need to consider agricultural relief. Dwelling house relief, which we haven't looked at in detail today, may also be available if there's residential property transferring between or within the family. And the final note there that I have is a small gift exemption. It's something that kind of goes unnoticed, or people don't pay enough attention to it, in my opinion. The small gift exemption allows 3,000 euros a year to be received from any one person. So to put that, I suppose, and everybody on this webinar can give me 3,000 euros today, and I'll pay no CAT on any of those receipts. Okay. So put that into a family scenario. If you have a mother and a father, can each gift their daughter 3,000 euro. That's 6,000 euro to the daughter. If the daughter is married, they can each give 3,000 each to their son-in-law. That's another 6,000 euro. If the daughter has 3 children, they can each give 3,000 to each of those 3 children. So you're gone to 30,000. Over 10 years, that's 300,000 euros that can transfer. That's if the thresholds are going to be used up with other assets, that's 100,000 euros of CAT saving. Okay. Now, that will only work in situations where your client or your own personal circumstances where the cash is available to allow for that transfer. But it's something that we've started to put in use. It's something that we have a number of clients who are now working on a structure that they transfer these amounts each year because the thresholds are protected and the cash is transferred. So over 10 years, that could be 300,000. Over 20 years, that could be 600,000. If the family is in a situation has the necessary wealth to allow them to do that, it certainly should be considered because over a number of years, the tax savings can be quite considerable. Okay, I'm going to pass you over to Michael now, and he'll take you through the rest of our presentation. Thanks very much.
Thank you very much, George. Michael Coburn here. Just to follow up on what George was saying, if anybody wants to put $3,000 in the post to him, we are in the phone book, but I think he's used that trick for about 2 years now, and as of yet, nobody has sent a penny. I want to finish up. We have about 15 minutes before we draw this to a close, and I want to look at inheritance tax treatment of pension assets before and after the point in time whereby somebody may or may not have drawn down a pension. And also I want to have a quick look at Section 72 life policies. So a quick whistle-stop tour of pensions before we start looking at how they may or may not be treated from a CAT perspective. The first point to note is that there are a range of different types of pension structure. I've highlighted a few on the screen there. We have personal pensions, PRSA pensions, executive company director pensions, and so on and so on. And the reason why that might be important is there are effectively different rules in terms of, be it access age, tax-free cash entitlement, the availability of approved retirement funds, or the compulsion to take an annuity, and so on and so on. But crucially, the form of payout on death before retirement is different depending on the particular type of pension structure. And then as a result of that, the form of payout on death after retirement can be slightly different. So I suppose a little bit of background info first, just to understand how pensions are drawn down in the normal course of events. So I've picked a personal pension. which is what you see on your screen there. So take, for example, an individual with a €300,000 pension fund. In the normal course of events, they would be entitled to draw down a quarter of the value of the pension fund tax-free, which in this case is 75,000. The balance, i.e. 75%, which is 225,000 based on this example, can be drawn down in one of three ways. And you can see there it's an annuity, an approved retirement fund, or an approved minimum retirement fund. And I will get to a quick explanation of those in a second. But in terms of understanding pensions payout before the pension has been accessed, so if we're at the point whereby an individual passes away whilst their pension fund is intact, how is that pension fund paid out, and what are the CAT considerations in relation to that particular pension? Well, it goes back to the issue of it depends on what type of pension it actually is. So you can see there a personal pension would pay out in the format of a lump sum equal to the value of the pension. So if there was 300,000 in the personal pension, and let's say the personal pension was intact and an individual passed away, let's say at age 59, for example, the value of the pension would be paid out as a lump sum. And then if you bring that to a logical conclusion, I suppose it's highly likely that the pension is paid out to that person's spouse, in which case there are no CAT considerations. But you can see there, depending on the pension type, it might not necessarily be so straightforward. So an executive pension, which is the type of pension that typically company directors are likely to have. In the event of death of such a company director, in the event of death before they have accessed their pension, so the pension fund is still intact, an executive pension pays out in the form of a lump sum equal to 4 times that person's salary, plus a refund by form of a lump sum of any personal contributions the company director has made into the pension scheme, and the balance of anything that's left in pays out in the form of an annuity. So here's an inheritance tax planning tip. I think it's very important. So what I have there on screen is, take for example an €800,000 executive pension fund with a company director on a salary of 100,000 per annum, and this individual, let's say, passes away in their mid-50s. Well, based on a salary of €100,000 per annum, it would pay out in the form of a lump sum of 400,000, i.e. 4 times 100,000. Let's assume for a second that there are no personal contributions by the company director, so the other 400,000 that's in the pension scheme were pension contributions made by that person's company into the pension. So the 400,000 remaining pays out in the format of an annuity. And we've looked at annuities already, so we will look at annuities in a second, but effectively an annuity is a process whereby the pension provider stroke the insurance company keep hold of the 400,000 and pay it out as a guaranteed income for life. But annuities, for reasons which we look at in a second, aren't particularly attractive. So there actually is a fix for something like this. If you had a company director who, let's say, for example, had been into their GP or their consultant and gotten some bad news, after their consultant, GP, and their family, the next trip they might be taking is into your good selves to make sure that they have their will constructed in some kind of a tax efficient manner. Well, a company director with an executive pension, before their untimely death, they can transfer, or they could transfer, the 800,000 in the executive pension into what's called a retirement bond, so that a retirement bond in the event of death pays out to the tune of a simple lump sum equal to the value of the retirement bond. So we've gone from a situation whereby the 800,000, instead of being paid out as a 400,000 lump sum and a 400,000 in the form of an annuity, it's now paid out as an 800,000 lump sum. So it's a pretty big step in terms of an important measure to be able to put in place for somebody and to advise somebody on, and it can make a huge difference in terms of looking after that person's family at a later date. So that's looking at how pensions might be paid out in the event of death whilst the pension fund is intact. So what we want to look at now is how the pension might be paid out in the event that, let's say, 60, 61, 62, whatever the age might be, somebody has accessed their pension, they've gotten their tax-free lump sum, and the balance of the 225,000, how would that be treated? The first thing to look at is on that person, when that particular individual accessed the pension in the first instance, after taking their tax-free cash, what did they elect to do with the 225,000? So we're back to, we have three options, or they would have been presented with three options at the time: the annuity, the approved retirement fund, stroke approved minimum retirement fund. And just to understand those three options, an annuity effectively is where the insurance company retain ownership of the value of the pension fund, or 75% of the pension fund, and pay it back in the form of a tax or an income tax assessable income to that person for the rest of their life. Annuities aren't particularly attractive at the moment, I suppose primarily driven by the fact that annuity rates are quite low. So, for example, if you were allowing an insurance company to retain ownership of, based on our example of 225,000 of a pension fund, annuity rates for somebody in their early to mid 60s at the moment might be 3 or 4%. So, effectively, the insurance company are retaining ownership of that money. So you would have the privilege of getting it back at the rate of 3 or 4% per annum. So it doesn't take a genius to figure out that you're going to have to live to be a ripe old age to get the full value of what the insurance company has kept. The ARF and AMRF options, we're a little tight for time here this evening, but effectively they are mechanisms whereby you have the option of retaining ownership of the balance of your pension fund in the format of an approved retirement fund or an approved minimum retirement fund. And really what it means is that you have the freedom to dip in and out of your approved retirement fund for income as and when you see fit. And in the event of your death, monies that you haven't spent that are still in your approved retirement fund, stroke approved minimum retirement fund, can form part of your estate. So really, I suppose what I'm saying here is going back to how pension funds are treated, where we're at the point whereby somebody has already accessed their pension fund. Well, if they opted for an annuity, and they pass away, if you're lucky, and depending on what way it was structured, their spouse may continue to get a small annuity payment. But from an inheritance point of view, approved retirement funds and approved minimum retirement funds are an awful lot more attractive. And in the event of that person, an individual passing away where they have their approved retirement fund and there are still funds in it, i.e. they haven't spent it all in the first 5 years having retired, the value in the approved retirement fund can form part of their estate. And how it's broken down is quite simple. If the person passes away and the approved retirement fund is going to their spouse or civil partner, it's not assessable for any kind of inheritance tax, and there is no income tax issue in terms of the spouse or civil partner taking ownership of the approved retirement fund. But it is important to note that once they start to draw down monies out of the approved retirement fund, that at that point whatever income they may draw out of it is assessable for income tax, but the actual event of gaining ownership of the approved retirement fund in the first instance doesn't in of itself trigger any kind of income tax liability. After that, it depends on who it's going to. If the approved retirement fund is going to a child aged under 21 at the date of death, there's no income tax consideration, but it's just assessable for inheritance tax. As to whether inheritance tax CAT is payable, I suppose it will depend on what other inheritances the particular child under the age of 21 might have received, and also the value of the approved retirement fund on the date of death. And if the child is over the age of 21, not assessable for inheritance tax, but is assessable at a very strange flat 30% income tax rate for some reason. So there is a small tax planning opportunity in that, be it kind of leaving an approved retirement fund to a child under or over the age of 21. Well, if it's under the age of 21, if the child is under the age of 21, you have an inheritance tax rate possibly there of 33%, versus over the age of 21, you have a flat income tax rate there of 30%. So there's a difference of 3% in the between those. So if the approved retirement fund, I suppose, is large enough, it might warrant a little bit of planning. Just maybe to leave the approved retirement fund to the right child, just to save on the CAT. So Section 72 life covers. Section 72 life covers, as many of you will know, they give relief from CAT where a disponer takes out a policy of assurance whereby the proceeds of the life cover are used solely to pay the possible inheritance tax. They can also be known as Section 60 policies. It's important to note that the proceeds of the life policy itself is not subject to inheritance tax. It's also important to note that, for example, if the inheritance tax bill was 300,000, but the life policy, the Section 72 life policy was in place, let's say, for 400,000, well, the difference of 100,000, that would be assessable for CAT. They are extraordinarily expensive, and it's a busy slide there. They certainly do have a role, but it comes down to a cost-benefit analysis. So what I have on your screen there under various headings, but you can see a client age 61 and cast your eyes across to the right-hand side with a possible inheritance tax liability, let's say at age 61 of 1 million, nice round figure. So the cost of a Section 72 whole of life cover for a person age 61 covering €1 million is 23,772 per annum. So you can see, for example, client age 61 pays out 23,772 over the course of a year to cover the cost of the Section 72 life cover. If they passed away, let's say, kind of 12 months exactly after taking out the cover, well, the life cover is going to pay out 1 million. So I suppose if you're looking at the family as a whole, it's cost 23,772. There's €1 million of a payout. So in terms of cost benefit, the family as a whole is up 976,228. And then if you take, for example, should that person pass away at age 80? So if you cast your eyes across to the left-hand side of the screen, about halfway down, the person passes away at age 80. The cumulative cost up until age 80 of the 23,772 per annum life policy is 475,000 odd euros, but it's still at that point paying out 1 million. So the family as a whole is still up to the tune of 524,500. So at what point does it cease to make sense? Well, right up until the age of 102, and should this person live to 103, it starts to not make sense. So I suppose what may dictate a person's decision on something like this is kind of life expectancy, let's say, possibly of their brothers and sisters and parents and grandparents. You could argue that if everybody in their family lived to be a ripe old age of 90 plus, well, chances are they might be looking at something similar. But if everybody in their family, if there was a family history of people passing away in their 70s and 80s, that you might look on it a little bit differently. Also, because of the costs involved, it really only suits somebody who has a lot, I suppose, of what I would call passive income, because obviously at age 80, hopefully they're for their own sake, they're not going to be actively working. So it might suit somebody maybe with a number of investment properties and pension income, whereby their ability to cover the cost of the premiums is not dependent on their ability to get up and go to work each morning. So it does play a role. It can be very expensive, and it has to be looked at on a cost benefit basis. A quick slide here. Myself and George here have looked at kind of all of the ins and outs of how to make and how to understand and take full advantage of the system that's there. I have a quick slide here. An awful lot of what myself and George will do is I suppose trying to help people understand whether they're in a position, irrespective of whether they can get the best deal in terms of keeping various taxes down, but to try and put them in a position whereby they can broach a topic like this, safe in the knowledge that, look, if they give the business to little Johnny or to Mary, that from their own income point of view and from their own quality of life point of view, that they're going to be, I suppose, able to fund their own retirement. So it makes their decision an awful lot easier if they can see, well, what is the 20, 30, 40-year impact of us starting maybe to pass some property along to the kids or the business, and so on and so on. So we have invested quite heavily, and apologies, this is a little bit of a shameless plug, but we have invested quite heavily in quite a serious piece of financial forecasting software. And what you're looking at on screen there is probably one page of a 100-page report, but we can test various scenarios and put it in a fairly simple to understand graphic for people at this point in time. So what you have on the screen there is down the bottom of the screen is a client age 55 with a mortality age of 95 plus, going from left to right. And the various colours and charts on the screen there are, if you look at the dark blue, for example, that's that person's employment income from their business, so 100,000 a year. And you can see there at age maybe 62, the dark blue chart drops. So it was this person's intention, I suppose, to start working part-time, maybe on a consultancy basis. And then we have the light blue charts there, are rental income and future tax-free cash lump sums from pensions and sale of business and so on. And the black line is their projected expenses, including any CAT liability for themselves or income tax liability and so on. So we can test various scenarios, and you can see for this particular person, if you cast your eyes to 83, 84 years of age, their original plan, even once we've figured out the most tax efficient way of doing it, their original plan would have seen them enter the red line bars at aged 83, 84, which effectively is them running out of income. So we do tend to use this in conjunction with the tax planning work, whereby we can test, I suppose, the practicality of any particular solution that the client might have in their own head, just to make sure that from an income point of view, that they're not going to leave themselves short. So it may or may not be applicable to some of your own clients, and I suppose what we found is it helps clients to make decisions a little bit easier and a little bit quicker. I have another offer for you, and I see, based on the number of attendees here, we have this afternoon, about 25% of you have availed of this offer at this point in time anyway. So we are committed to solicitors, and we have an offer whereby we will, at no charge currently, I should say, but at no charge currently, we will undertake a small body of work whereby we will look at your existing pensions and give you an idea of what fees and charges might be on your own pensions, a look and commentary in terms of the investment volatility and risk of your pensions, and maybe some sight on what you can expect to get from pensions in terms of tax-free cash and income for yourselves at a future point in time. We make this offer. I suppose we found in the feedback from solicitors who have availed of the offer over the past couple of years is they do, and you will get a raft of useful information. And also, for those of you who don't know us, it's a good way to test us. So we will make the offer available to you. If you want to avail of the offer, there should be, on exit of the webinar this evening, there should be a screen that will come up on your own PCs, laptops, or tablets, and you can indicate, I think it's just a simple yes, no, as to whether or not you want us to contact you in relation to it. I would also say, just to wrap up here as well, that any tax queries that you might have for George, our email address, no doubt you will have it on various sources from us over the last number of weeks. But feel free to contact us if you want to pick our brains, or if you have queries for clients. I have been told it's close, bang on 5:01, so we're bang on an hour. We do have a couple of questions in here, but we're not going to get time to deal with them. But anybody with a question, please feel free to email it into us after. I'm just being asked by George to say something. We will respond individually as best we can to each question. I know you're probably all in a hurry to get home to finish off the Easter eggs before other people get to them. I would like to thank you very much for listening, and we hope to speak to you very, very soon. Thank you very, very much.